Let's talk about the stock market crash of 2024. Last week we saw one of the most dramatic stock market crashes in recent memory, followed by an unexpected recovery. By the end of Monday, 90% of the stocks in the MSCI All Country World Index had fallen in an indiscriminate global sell-off. Yet by Friday, the S&P 500 was down by less than 1%. In this video, we're going to dive into the psychology and structure of the global financial markets to understand what triggered this chaos. Does this represent a fundamental shift in economic conditions or the financial outlook? And more importantly, what is the worst thing you can do now? Stick around and I'll share with you that key takeaway from all this turmoil and a simple strategy to avoid making this catastrophic error. Let's talk about the calm before the storm. Leading up to last week, markets had been relatively stable after a sell-off last October. Since then, indexes had risen steadily, driven by the excitement surrounding AI advancements. Investors were growing increasingly complacent, convinced that the US economy was heading for a soft landing. Although US stock markets had been trending downward in July, they were still comfortably up for the year. The trigger on Friday the 2nd of August. The first major crack appeared on Friday the 2nd of August when US labour market figures came in below expectations, heightening fears of a potential recession. The Federal Reserve had previously held off a rate cut and signalled a modest 25% basis cut in September, but many questioned if this was too little, too late. The yen carry trade and the market domino effect. Another key factor at play was the yen carry trade. For years, investors had been borrowing cheaply in yen and reinvesting in overseas assets, particularly in the US. However, these trades are designed to be unwound quickly when conditions change. Many funds use algorithms to manage their trading, reacting rapidly to shifts in the market. In Japan, domestic retail investors had also been leveraging to increase their returns, concentrating heavily in equities. When equity markets fell, margin calls followed swiftly. Compounding the issue, the Bank of Japan raised interest rates at the end of July and hinted at further tightening to come. When markets opened in the Far East on Monday, the resulting sharp sell-off triggered a domino effect across global markets. The Monday meltdown. The sell-off was exacerbated by quantitative funds with strict limits. The trend following portfolios, volatility control funds and other computer-driven strategies had begun cutting equity exposure rapidly, selling off not just stocks but also bonds and commodities. As market volatility soared on Monday, volatility control funds, which typically buy when markets are calm and sell when they're volatile, joined in the selling spree. To visualize this, think of the world's financial markets as a large, interconnected lake. Different areas represent different markets, equities, bonds, options, currencies, and different geographical regions. When a stone is thrown into one part of the lake, ripples spread across, affecting all markets in some way. Last Monday, it felt like rocks were being hurled into the lake from all directions. The recovery. What changed? By the end of Monday, the market was looking much better valued, and the volatility had begun to calm down. This set the stage for a recovery throughout the rest of the week. Several factors contributed to this turnaround. The Bank of Japan made a statement that it would not raise rates further while markets remained turbulent. The Federal Reserve resisted the urge to panic into a rate cut, despite calls for as much as a 50 basis point reduction. Buyers returned to the market, recognizing that the economic fundamentals hadn't changed and the market's underlying structure had held firm. So what's next? Does this mean we're in for a smooth ride for the rest of the year? Not necessarily. With the US presidential elections on a knife edge, more volatility is likely. The potential for a Trump 2.0 presidency or the economic policies of Kamala Harris, along with ongoing geopolitical tensions in Europe, the Middle East and between China and Taiwan, will continue to impact markets. And while cryptocurrency remains outside my area of expertise, it's clear that it doesn't provide the stability that markets crave. Before I give you the lowdown on the worst mistake, let me give you a bonus tip which is particularly useful in market conditions like this. Keeping a cash reserve. In volatile markets, having a cash reserve is invaluable. It allows you to take advantage of buying opportunities when stocks are undervalued without needing to sell assets at a loss to cover immediate expenses. This financial cushion gives you the flexibility to make strategic investments rather than reactive ones. By keeping a portion of your portfolio in cash, you're prepared to capitalize on market downturns and position yourself for the long-term gains as the market recovers. Remember, patience and preparedness are essential when navigating through turbulent times. Let's consider a real-world example. During the 2008 financial crisis, savvy investors who maintained a cash reserve were able to purchase high-quality stocks at significantly reduced prices. Companies like Apple and Amazon, which faced steep declines during the crash, eventually rebounded and delivered substantial returns to those who bought at the lows. Those investors were able to use their cash reserves to buy shares when others were forced to sell due to financial strain. This strategy underscores the importance of staying liquid during uncertain times rather than panicking and selling off assets. A well-timed purchase of undervalued stocks can lead to impressive gains once the market stabilizes. It's about having the confidence and the resources to make bold moves when others are fearful. Another Warren Buffett quote. By keeping a cash reserve, you're not only safeguarding your portfolio, but also putting yourself in a position to act when opportunity strikes. So, this brings me to the crux of this video. What is your worst mistake? What is the worst thing you could possibly do now? Well, the worst thing you can do at times like this is to sell. In the long term, the market always recovers, and particularly after presidential elections. So sit tight. As Warren Buffett famously said, if you don't like market volatility, you shouldn't own stocks. Benjamin Graham's Mr. Market allegory also teaches us about the irrationality and contradictions of the market. So my strategy is simple. Don't try to time the market. Spend time in the market. This is another pillar of Buffett's investing philosophy. Instead of trying to trade through the roller coaster, focus on finding great companies, buying them at great prices, and holding them for the long term. It's an unexciting strategy, but it's simple and easy to follow. Remember, volatility is a natural part of the market. With the right approach, you can navigate these waves and emerge stronger on the other side. So I hope you enjoyed this content. Make sure that you like and subscribe and share the video for more in-depth market analysis. And if you want to learn more about investing and timing and Warren Buffett, then you really want to watch my video on Warren Buffett and investing, which you can find on the link on the page right here. So stay informed, stay calm, invest widely, and I'll see you in the next video.